Hey everyone. In the previous class, we talked about the 9-step accounting cycle. So here are the 9 steps. If at this time you still don't know this 9-step accounting cycle, make sure that you know them by the end of the semester. They're definitely going to appear on your final exam. And in this class, we're going to talk about accounting for merchandising operations. So first of all, we're going to talk about those merchandising companies, for example, for Target, Safeway, Walmart, those are examples of merchandising companies, how they operate. They have 2 major activities. One is purchase, the other is sales. So when the firm is doing the purchasing activity, how to account for it. And when the firms are doing sales activity, when they sell their product, their inventories, their goods, how to account for that. And after that, we're going to talk about 2 major financial statements, income statement and balance sheet in more detail. So that is the plan for this class. First of all, what are merchandising companies? So in this class, we're going to focus on talking about the accounting for merchandising companies. And first of all, what are merchandising companies? Merchandising companies those are basically companies which operate by buying and selling merchandise. So that is the definition for a merchandising company. And examples of merchandising companies, for example, REI, Walmart, Amazon, Target, Trader Joe's. So all of those are examples of merchandising companies. And this is a graph about, for a merchandising company, what its operating cycle is. So how merchandising companies operate, it's actually pretty simple. So they first of all, they have cash and they use cash to buy some inventory. And then they sell those inventory to consumers. Sometimes they get cash back immediately. Sometimes it will be in terms of account receivable. And after they get account receivable back in cash, they can buy more inventory and they sell those inventory. So that is a cycle. And this cycle is called an operating cycle. Operating cycle is basically the time it takes for a company to purchase inventory, sell it, and collect cash back from customers. And the firm just operating around this cycle again and again. So we just talked about the definition for a merchandising company. And the merchandising company, they have 2 major activities. In order to complete an operating cycle, they need to first purchase and then they need to sell. So purchase and sales, those are the 2 major activities of a merchandising company. And for accountants, what we are interested in is when the firm is doing a purchase, how to account for it. And when the firms are doing sales, how to account for it. Or in other words, what is the general entries for purchase? And what is the general entry for sales? And before we can talk about what are the general entries for purchase and sales, we need to first talk about the 2 different kinds of inventory systems firm may use. The accounting for purchase and sales, they differ depending on what kind of inventory system the firm is using. So what are those 2 types of inventory systems? The first type is called perpetual inventory system. And the second type of inventory system, it is called periodic inventory system. And as I just said, the accounting is going to be different for purchase and sales, depending on which kind of inventory system that is used. And specifically, so what are the difference between this perpetual and periodic inventory system? What exactly do we mean if a firm is using a perpetual inventory system versus if the firm is using a periodic inventory system? And here are the differences. So perpetual inventory system, just understanding it, the word perpetual, what does it mean? Perpetual inventory system is basically the firm is keeping a perpetual record of all of the purchase and sales of its inventory. So the firm keep detailed records of cost of each inventory purchase and sales. And because the firm is keeping a detailed record, a perpetual record of all of the inventory purchase and sales, so the firm is able to determine the cost of goods sold at any point in time. Each time it make a sale, or at any point in time, the firm knows what is its cost of goods sold and what is the cost of the ending inventory. Versus periodic. Under a periodic inventory system, the firm actually, it doesn't keep record of the goods it has sold. So as a result of this, the firm also doesn't know how much inventory it has on hand. And then you may be asking, then how does the firm know what is the cost of goods sold and what is the cost of the inventory that is on hand? Actually, the firm doesn't know until the end of the financial reporting period. So, for example, the firm has 2 pieces of inventory on hand at the beginning, and then the firm purchased 3 pieces during the period. The firm sold something, but because the firm doesn't keep record of how much it has sold, so we don't know that how much has been sold. And then, depending on how much the firm has sold, the firm is going to have an ending inventory. So this is the equation. And then in order to know how much the firm has sold, what actually has been done under a periodic inventory system is the firm is going to go in to take a physical count of how much inventory the firm has left. So for example, the firm does a physical count and they find out that it has 4 pieces of inventory left at the end of the financial reporting period. So how much inventory has the firm sold? The firm has 1 at the beginning, 2 pieces at the beginning. They purchased 3, they have 4 pieces left. So this must mean that the firm has sold 1 piece. This is how the firm knows how much inventory it has sold during the financial reporting period, by taking a physical count of how much inventory is left. And without a physical count, because the firm doesn't keep detailed record of how much inventory it has sold, so the firm is not able to figure out how much it has sold. It can only be done by a physical count at the financial reporting period. So this is the periodic inventory system. And then we just talked about the difference between periodic and perpetual inventory system. Now we can talk about how to account for purchase and sales. So first of all, how to account for it when the firm does a purchase, when the firm purchases something. Purchase can be done either using cash or on account. Or account is also called credit, a credit purchase. So depending on whether the firm is using perpetual or periodic inventory system, if the firm is using perpetual inventory system, whenever it purchases some inventory, the general entry is to debit inventory, credit either cash or account payable, depending on whether it is a purchase using cash or if it's a purchase using credit. If the firm is using periodic inventory system, the only difference is instead of debit inventory, the firm is going to debit purchase. And the purchase is a temporary account. The normal balance for this account is on the debit side. And this account, at the end of the financial reporting period, it is going to be closed out into the inventory account. So those are the 2 general entries. And for the purpose of this course, on your homework and on all of your exams, you are only required to know the general entries for perpetual under the perpetual inventory system. So for periodic inventory system, this is I'm mentioning it here just for you to know so that you won't get confused if you choose to take some higher level accounting course in the future. This is just for the completeness of what I think you need to know here. But you actually for the journal entries themselves, you are not going to be tested for this journal entry. You only need to know how to do journal entry under the perpetual inventory system for this particular class. And so this is the basic journal entry to record a purchase. However, the actual situations that can come out in practice, it can get a little bit more complicated than this simple journal entry. So first of all, purchase and sales, they are usually associated with shipping. Whenever a firm is purchasing something, how can the supplier deliver the good to the firm who's purchasing it? It's usually they need to ship it. And whenever the firm is selling something, a lot of the time they need to ship it out. So yeah, once there's shipping involved, the firm needs to make journal entry for that as well under some situations. So there are two types of shipping, depending on the shipping terms. The first is called FOB shipping point. The second is called FOB destination. And FOB here means free on board. So what are the differences between FOB shipping point and FOB destination? The seller is here and the buyer is here. So here, this is how the good is shipped to the buyer. And if it is FOB shipping point, basically the ownership of the good is passed to the buyer at the shipping point. Versus FOB destination, the ownership of the good is passed to the buyer at destination. So if the ownership of the good is passed to the buyer at the shipping point, FOB shipping point, usually the buyer pays the shipping cost. Versus FOB destination, that is usually the seller pays the shipping cost. So how does it matter for us? This is an accounting cost. So how to account for it? So the what matters for us here is if the firm is someone who's purchasing the item, and it is also the FOB shipping point, which means the buyer is paying the shipping cost. Then the buyer needs to account for the shipping cost it has paid. And the journal entry for that is, if it is under perpetual inventory system, the shipping cost that has been paid is going to be included as part of the cost of the inventory. The journal entry is to debit inventory, credit cost, cash or account payable. Versus if it is periodic inventory system, we debit freight in, credit cash or account payable. And freight in here, it is a temporary account as well. The balances for this account is going to be closed out into inventory account at the end of the financial reporting period. So this is about shipping. And things may get a little bit more complicated than this as well. So sometimes after the buyer has bought something, it may decide to return the product it has purchased. And then what is the journal entry for the buyer at this point in time? So in the perpetual inventory system, we basically reverse the journal entry the buyer has made at the time of purchase. So if you still remember from a couple of slides ago, when the buyer has purchased some inventory, the journal entry is to debit inventory, credit cash, or account payable. And when the buyer decides to return those inventory, it just reverses that journal entry by debit cash or account payable and credit inventory. And if it is under periodic inventory system, the difference here is instead of credit inventory, we credit purchase returns and allowance. And this is again a temporary account. The balance for this account is going to be closed out into inventory at the financial reporting period end. So this is about if the buyer decides to return the products it has purchased. And then things can get a little bit more complicated than this. So sometimes if it is a credit purchase, it may associate it with some credit terms. An example of this is sometimes the seller may allow the buyer, for example, 60 days to pay the full amount. However, if the buyer pays within 20 days, seller may give the buyer some incentive, for example, 2% discount. And this is written as 2 out of 20 and out of 60. So how to read this term? This term basically means that if the buyer pays within 20 days, it is going to get 2% discount, and it needs to pay within 60 days, no matter what. And this is an example of the discount term buyer can get, which is associated with a credit purchase. And then the question for accountant is, if buyer decides to take this discount and pay early, what is the journal entry? So if the buyer decides not to take the discount, the journal entry is very simple. So if not take discount, which means that the buyer pays after 20 days. The journal entry when the buyer pays is the buyer is going to debit account payable, credit cash. The firm pays out cash, so cash decrease. And then the firm now no longer has this obligation, this account payable. So account payable decrease as well. So this is the journal entry if the buyer decides not to take the discount. However, what is the journal entry if the buyer pays early, decide to take this discount? The journal entry under perpetual inventory system is to debit account payable. So account payable decrease, and the firm pay out cash. However, the firm, because of this, the firm is taking the discount. For example, the original account payable is 100. And because the firm pays early, the firm only need to pay 80. And the other 20, this is the discount the seller has offered to the buyer. And this 20 is viewed as a decrease in the cost of the inventory. So debit account payable, credit cash, credit inventory. This is under perpetual inventory system. And if the buyer uses periodic inventory system, the only difference here is instead of credit inventory, the buyer is going to credit purchase discount. And this account, purchase discount, it is again a temporary account. The balance for this account is going to be closed out into inventory at the financial reporting period end. So those are some of the basic situations that may happen when the firm is doing a purchase. And here is an example. Please take 5 minutes. Try to work on this example on your own. And we're going to, you can pause your video for now. So let's look at the journal entry under perpetual inventory system first. The firm purchased 3,800 merchandise from this company on account. And the journal entry is to debit inventory for 3,800 and credit account payable for 3,800. And then the shipping term is FOB shipping point. So this is the shipping. We have buyer and we have seller. And if it is FOB shipping point, it means that this, we have the seller here, and we have the buyer here. If it is FOB shipping point, ship goes this way. So if it is FOB shipping point, it means that the buyer is going to pay the shipping cost. And then the journal entry, so the buyer pays the shipping cost 150 in cash. So the journal entry is to debit inventory, and this cost is counted as the cost of the inventory. Credit cash 150. And then the credit term given by the seller is 2 out of 15 and out of 30. So the meaning for this is the firm needs to pay within 30 days, no matter what. And if it pays within 15 days, it can get 2% discount. So we're going to put it aside for a while and go on reading. So this is happened on May 6th. And on May 8th, the firm returned goods costing 300. So here we basically reverse the first journal entry for 300 by debit account payable 300, credit inventory for 300. And then on May 14th, the firm paid the total amount owed. Now, because the firm paid within 15 days, so the firm is going to get 2% discount. So what is the total amount the firm is paying on May 14th? The firm originally owned 3,800 and it returned 300. So now the amount owed is 3,500. And then the firm can take 2% discount. So this means that the total amount that needs to be paid is 3,430. So the firm pay out cash 3,430 and account payable decreased by 3,500. The rest is viewed as a decrease in the inventory account, which is 70. So those are the general entries. And then if we look at the periodic inventory system, the first journal entry, the difference is instead of debit inventory, we're going to debit purchases. The second journal entry, instead of debit inventory, we're going to debit freight in. And the third journal entry, instead of credit inventory, we're going to credit purchase returns and allowance. The last journal entry, instead of credit inventory, we're going to credit purchase discount. And all of those A, B, C, D, those accounts, all of those are temporary accounts. Those are going to be closed out into retained earning at the financial reporting period end. Or in other words, that no matter what system, whether it's perpetual or periodic inventory system, no matter what system the firm uses, as investors, you are going to see the same. So the balances for inventory is going to be the same, no matter what kind of system the firm use, because all of those temporary accounts under the periodic inventory systems, those are going to be closed out into inventory account eventually at the financial reporting period end. And here's a summary. So if we summarize how those accounts, what are the accounts that are affected and how do those accounts change as a result of all of those journal entries during the period. We are going to say that actually for the perpetual inventory system, only 3 accounts are involved. For periodic inventory system, so the account payable is exactly the same as under perpetual inventory system. The cash account is going to be the same. The difference is under perpetual inventory system, we have the inventory account, which actually collect all of the firm's purchase, freight in, purchase returns, and purchase discount. So everything just goes into the inventory system. inventory account. Versus in the periodic inventory system, we're separating them into different accounts. So this is the accounting for purchase. And another very major activity for a merchandising company is sales. And then the question for accountant is how to record sales, how to account for sales. Companies record sales revenue when the performance obligation is satisfied. And what is performance obligation? Performance obligation, that is basically obligation to perform. So, and those obligations are satisfied. Usually if it is a company that deals with goods, that is usually when goods are transferred. And if it is a company that provides service, that is when services are provided. So very similar as a purchase, sales can be made either for cash or on credit. The journal entry, whenever the basic journal entry, whenever the seller sells something under the perpetual inventory system, the seller is going to debit cash or account receivable, credit sales revenue. And at the same time, because the seller sold something, so its inventory is going to go down. We need to record the decrease in inventory. At the same time, we need to record the cost of those inventory that has been sold. So debit cost of goods sold, credit inventory. And those are the two journal entries under the perpetual inventory system whenever the seller has sold something. Under periodic inventory system, the difference here is we only record the sale of goods. Under the periodic inventory system, if you still remember, the seller actually doesn't keep record when it sold something. It doesn't even know how much item it has sold. It does either collect cash or it does make a record of how much it's going to collect, but it doesn't keep record of the inventory side. So we don't have the journal entry about the inventory here. And this is the basic inventory for sales. Very similar as purchase. When the seller sells something, if it is FOB destination, the seller is going to pay the shipping cost. And what to do when seller pays the shipping cost, how to account for that. The journal entry here is to debit freight out, credit cash or account payable. And this freight out, it is actually an operating expense. So it is an income statement item. And this journal entry is the same for both perpetual and periodic inventory systems. And then what if the buyer decides to return the product purchase? So from the seller's perspective, if the buyer decides to return some of the products that the seller has already sold, under perpetual inventory system, we basically kind of reverse the previous journal entry, but with some small differences. The difference here is instead of debit sales revenue, we debit an account called sales return and allowance. And this account, it is a contra account to the revenue account. So the end effect is it's going to cause the same effect on our net revenue as you debit sales revenue directly. But we don't want to do that. We want to separate out how much is it that was returned. So instead of debit sales revenue directly, we debit another account called sales return and allowance. And then the second journal entry is basically we reverse the previous journal entry. When the firm sold something, we debit cost of goods sold, credit inventory. And now when those items that has been sold is returned, we debit inventory, credit cost of goods sold. So this is under perpetual inventory system. Under periodic inventory system, we don't have the second journal entry. So this is when buyer decides to return the product that has been purchased. And then what if So if the seller is offering some discount term to the buyer and the buyer decides to take the discount and pay early, what is the journal entry for the seller? If buyer does not pay early, the journal entry is going to be very simple. Whenever the buyer pays, the seller gets cash. So debit cash, credit account receivable, because now the seller doesn't have that receivable. It's already been paid. However, if the buyer decides to take the discount and pay early, the journal entry is to debit cash, credit account receivable. So for example, the account receivable is 100. And because the buyer takes the discount, so now the buyer only needs to pay 80. And the rest 20, that is called sales discount. And this account, sales discount, it is also a contra account to the firm's sales revenue. It's going to decrease the firm's net sales revenue on the income statement. And this journal entry is the same for both perpetual and periodic inventory system. So those are the journal entries. And please take some time, try to continue. So this is a continuation of the previous example. And now we have some additional information with regard to the cost of the merchandise that has been sold and the cost of the merchandise that has been returned. Please take 5 minutes, try to work on this example, and you can pause your video for now. So let's go back to look at the previous one. So previous one here, under the perpetual inventory system, those are the journal entry for the buyer. And now let's look at the seller. What are the journal entry for the seller? For the seller, first of all, the buyer bought inventory costing 3,800. And from seller's perspective, it sold inventory. And those inventory was sold for 3,800. So for seller, the firm has account receivable of 3,800. And it is sales revenue for the firm, 3,800. At the same time, because the firm has sold those inventory, so inventory goes down. And the cost of those inventory is the cost of goods sold for the firm. And that is 2,400. So this is the journal entry for the seller at the time of sale. And then the buyer here pays the shipping cost. So the seller doesn't need to do anything. The buyer return inventory, the value of those inventory is 300. And now the seller's journal entry is to debit sales, returns, and allowance for 300, credit account receivable for 300, and the cost of those inventory is 140. So debit inventory 140, credit cost of goods sold for 140. So this is the journal entry when the seller, when the buyer returns those goods. And then the buyer decides to take this credit term. So for the seller, it received cash 3,430 from the buyer. At the same time, account receivable goes down by 3,500. The difference is viewed as sales discount for 70. So this is the journal entry for the seller. And let's look at it written out like more so this is probably clearer to you than my handwriting. But we just talked about the journal entries here. And now let's look at the periodic inventory system. So under the periodic inventory system, basically we don't have this journal entry. So we don't have anything here. And also we don't have this journal entry. When those inventories are returned, we don't have anything here. But everything else is the same as under perpetual inventory system. And now let's do a very brief summary of the sales. So under perpetual inventory system, those accounts are this is not an account. So those are the accounts that are affected. And under periodic inventory system, those are the accounts that are affected. So the firm's net sales is sales revenue minus sales returns and allowance minus sales discount. And as you can see here that all of those are the same between perpetual and periodic. The only difference is under the periodic inventory system, it doesn't record cost of goods sold. It doesn't record the inventory. The firm has no idea before the physical count. The firm has no idea how much inventory it has sold and what is the cost of those inventory that has been sold. But the firm does know now how much cash it needs to receive in the future. So, and then you may notice that under the periodic inventory system, the firm missed out something in accounting recording. And in order to make up for that, the firm needs to make an adjusting entry at the end of the financial reporting period in order to adjust for all of those. So an additional adjusting entry needs to be made in order to record the cost of goods sold and in order to adjust the ending balance of the inventory. And the journal entry here is this. So this is not required for this course. This is just for your reference. How to read this journal entry? Basically, using this journal entry. So before making this journal entry, the firm needs to do a physical count in order to determine what is the quantity of the inventory it has at the end of the financial reporting period, and what is the quantity of the inventory that has been sold. And then according to some, we're going to talk about it in the next class when we talk about inventory. According to the cost flow method the firm use, we're able to determine what is the cost of the good that has been sold and what is the cost of the ending inventory. So these two, as long as we know when, we can figure out the other, because we know what is the cost of the firm's beginning inventory, purchase freight-ins, purchase returns and allowance purchase discounts. All of those we know. So these two, A and B, as long as we know when, we know the other. And we're going to talk more about it in the next class. But here, this journal entry, this is basically, we credit inventory, the balance of inventory at the beginning of the financial reporting period. And then we close out all of those account balance using those. So if you still remember, the purchase balance is at the debit side. In order to close it out, we credit purchase. And the freight-in, the balance is at the debit side. To close it out, we credit freight-in. Sell purchase return and allowance, the balance is at the credit side. To close it out, we debit purchase return and allowance, the same as purchase discount. And also we debit the inventory balance, which is determined by the physical count. And then the whatever is to make this journal entry balance, that is the cost of goods sold. So this journal entry is basically a repeat of what this equation is. But this part, you don't need to know it for the purpose of exam for this course. So we have talked about the journal entries for purchase and sales, and the closing entry is exactly the same as what we have talked about before. We use 4 closing entries. The first closing entry is to close out the sales revenue to income summary. The second closing entry is to close out all of the cost and expense to income summary. The third closing entry, close out income summary to retain earning. We also close out dividend to retain earning. So those are the closing entries. And now I want to spend some time talk about income statement and balance sheet. So income statement, there can be 2 forms. It can be made in 2 forms. One is called multiple step income statement. The other is called single step income statement. So I have 2 income statements here. Could you tell me which one is a multiple step income statement and which one is a single step income statement? Please take 1 minute, try to compare those 2 statements and just use your intuition. Which one do you think is a multiple step income statement and which one is a single step? You can pause your video for now. So in this example, actually, this is a multiple step income statement, and B is a single step income statement. What is the difference between multiple step and a single step? For a multiple step income statement, it usually shows several steps in determining net income. So for example, for this one, it first calculates gross profit, and then it calculates income from operations, and then we arrive at net income. Versus this one, we're not going to say anything. It just group out all of the revenue and group out all of the expense. So multiple step, and it shows several steps in determining net income. It also, one important thing for a multiple step income statement is it is going to distinguish between operating and non-operating activities of the firm. So what are operating activities? Sales revenue, cost of goods sold, those are definitely operating activities. And in addition to that, the firm may also have some operating expenses. What are operating expenses? Those are primary recurring costs incurred to generate sales revenue and conduct business operation. Versus non-operating revenue and expense, those are usually not related to the firm's primary line of business. So this is the difference between operating and non-operating. And examples of operating expense, we have sales expense, G&A. So anything paid to the firm's managers, those are the firm's operating expense. R&D, depreciation, salary and wage expense, utility, advertising, freight out, insurance. So those are examples of a firm's operating expense versus examples of non-operating revenue and expense. For example, interest revenue, dividend, rent revenue, gain or loss from sale of PP&E. So rent expense, that is an operating expense for the firm. However, rent revenue, that's usually non-operating. Can you understand why? Why is rent revenue not operating? So unless this is a real estate firm, which to whom the primary line of business is renting, then rent revenue is going to be the firm's operating. So it's going to be its primary, like rent revenue, it's going to be the top line revenue. Other than that, for most of the firms, if the firm has happened to have a separate spare building, it decided to rent it out to generate some additional income. The revenue get from that is not operating because the firm is not relying on that as its primary business. So similarly, interest revenue and expense, dividend revenue and expense. If, for example, Starbucks the primary business of Starbucks is to sell coffee. And if Starbucks happen to have some additional cash, it decide to put in the bank to earn some interest revenue or invest in some stocks to get some dividend revenue. Those interest and dividend revenue, they are not counted as the operating revenue and the expense for Starbucks, because it has nothing to do with sell coffee. The Starbucks is not relying on that to generate revenue. That's why those are non-operating. Similarly, gain or loss from sale of PP&E, if the firm has a machine that it has used for a while and now it decide to sell it, either at a gain or loss, the gain or loss which comes from the sale of that machine is not going to be counted as the operating revenue or expense for the firm. Those are non-operating. So this is about multiple step income statement. And so here, again, this is a typical multiple step income statement. We first start from the firm's sales revenue, and we take out sales return and allowance sales discount. We arrive at the firm's net sales, which is 380,000 minus 20,000. And then the firm's cost of goods sold is this amount. So the difference, for example, this is A, this is B, A minus B, this is the firm's gross profit. And then the firm also have some operating expense. So this is C, oh, sorry. So for example, this is C, and this is D. So this thing, income from operation, E is C minus D. So the firm's gross profit minus the firm's operating expense. And then after that, the firm may have some non-operating revenue and non-operating expense. So we just E, F, G. So this is the firm's net income is H. It's going to be equal to E plus F minus G, plus the non-operating revenue minus the non-operating expense. So this is the firm's income statement if it's a multiple step income statement. We also mentioned another kind of income statement called single step. And the single step income statement is much simpler than a multiple step income statement. We just classify all of the data into two categories. One is revenue, the other is expense. So the revenue part can include both operating revenue and other revenue, non-operating. The expense part can include cost of goods sold, operating expense, and non-operating expense. So we just group all of the revenue together and group all of the expense together. And here is an example. So this is A is the sum of all of the firm's revenue. B is the sum of all of the firm's expense. And net income C equals to A minus B, the revenue minus expense. So this is a single step income statement. We have talked about income statements. Now let's look at the balance sheet. This is an example of a balance sheet. Balance sheet mostly have three categories: asset, liability, and stockholders' equity. And within asset, we have current asset and long-term asset. Within liability, we have current liability or long-term liability. Current asset is also called short-term asset, and current liability is also called short-term liability. So what are current assets? Current assets are basically the assets that a company expects to be converted into cash or used up within 1 year or one operating cycle, whichever is longer. For most of the firm, its operating cycle is smaller than 1 year. But for some firms, they may have operating cycle longer than 1 year. And in that case, we just take whichever is longer. And examples of current assets, so we have cash and cash equivalent, short-term investment, account receivable, inventory, and those are some examples of a current asset. If it is not current asset, then it is long-term asset. Examples of long-term assets are long-term investment, PP&E and intangibles. And here are some examples of PP&E. Here are some examples of intangible assets. And then similar as current asset, current liability, those are obligations that the company is going to be paid within 1 year or one operating cycle, whichever is longer. And examples of current liabilities. So those are the examples. And one place to pay attention is the firm may have some long-term obligation, but if part of that long-term obligation matures within 1 year, so the current maturity of long-term obligation, that also counted as the firm's current liability. And then long-term liability. So if it is not short-term liability, it is long-term liability. Examples are bonds, notes payable. So all of those needs to be long-term in order for them to be qualified as long-term liability. Sometimes notes payable can also be short-term, and it's going to be indicated whether it's short-term notes payable or long-term notes payable. So the last category is stockholders' equity. Stockholders' equity, here are some typical accounts for stockholders' equity. And we're going to talk about those in more detail later in the course. So yeah, this is what this chapter is.